Hello, everybody. It's Hammer. Today is November 23rd, 2022. My name is Hammer. I am your rate guru. Today. So anyway, here, welcome to your mortgage market update. If you are here live, go ahead and let us know that you're here. Say hello. Let me know that you're here live. Give us a hashtag live. Say something in the comments. Be a part of the conversation. Ask any questions you have. Share any thoughts that you may have. I know today's not going to be a huge day right before Thanksgiving. Very few people worried about what's going on with rates today, but we're gonna keep you in. And if you are watching on the replay, which is probably more likely, we do go ahead and monitor this post. So give us a hashtag replay. Let us know that you are here. Let us know that you want us to keep bringing you this information each and every week. Great to have all of you here. And I see somebody that is here live. If you're here, there's a little link somewhere that you can click and it'll show your name, but let me know who you are. Certainly appreciate you. And wonderful, kind words. Another person thankful for me. Thank you. I appreciate that. That means a lot to me. Glad to give what I can and help everybody out. So thank you, though. That is very, very kind. So we're going to keep it nice and quick today. Let's go ahead and jump right in. Here he is. I did have a guest today, and it looks like he has hopped in. Let me go ahead and add him to the stream. What's up, Mr. Anthony? How are you?
I'm doing well. I forgot to click the button. I had it on. I had the setting on, and I'm like, okay, I can see myself. It's fine, but I forgot to actually come into the room.
No problem. We got you in here. So welcome, everybody. Anthony Patton. Anthony, please take a minute. Tell everybody a little bit about yourself, where you do business, and how long you've been in the business, that kind of thing.
Yeah, so I am located in Texas. I do Texas, Tennessee, Florida, and I've been in the mortgage business, closed my first loan in 1989. So
you're just starting to get the hang of it now.
Yeah,
that's good.
I feel like I've seen everything you could possibly see, and then something happens, and I'm like, no, that's new. So you still learn every day that something new is going to happen.
Absolutely. Well, thank you for joining me. So I've already done some of the preliminary stuff. So let's jump right in. Let's start off with a quick rate recap, just to remind everybody when we talk about this stuff, it's not an offer to lend. When we talk about rates, we're talking about averages and generalities. Your situation is always going to be unique based on your credit score, based on whether you're getting a VA loan or a different loan. So always remember to shop your rate. But I mean, a quick recap, rates were basically unchanged over the last week after we saw a very dramatic decline a couple weeks ago. So we got that inflation data a couple weeks ago, came in and helped rates really drop down. One of the biggest rate drops we've seen in a couple of decades, actually. I think it was since 2008, the largest rate drop. We saw rates go down about 0.5% on average. VA rates now in the low sixes as a starting point. Once again, before factoring in any adjustments like your credit score or other variables. Conventional rates are a bit higher, closer to 6 3/4, maybe 6.625, or what we say 6 5/8 before adjustments. Anthony, how's that sound to you? Does that sound about right?
Yeah, that is about right. That's what we're seeing.
Okay.
Like you said, there was a huge move in the market right before Veterans Day. I said it had to do with them changing in Veterans Day, but that was a huge move, and I think caught some people by surprise for sure.
Yeah, in fact, there was a nice article here. I'll pull it up and we'll throw it on the screens real quick since we're here. There was an article here in Bloomberg. U.S. mortgage rates dropped for a second week, hit 2-month low. This is just to remind everybody, when you see stuff in the media, it tends to be a little bit delayed. That's why they talk about it dropping for a second week, where rates didn't really drop from the week before. They dropped and stayed low is kind of where we're at. As far as hitting a 2-month low, I would say that probably is pretty accurate. We had seen rates in the 5s back in July. It seems like decades ago, like back when you started, Anthony, in 1980 something. I know rates were a lot higher, but it just seems like it was a long time ago. But we have seen them go back. So that's pretty good. But well, everybody always wants to know, hey, is now a good time, or what should I do? And where are rates going to go from here? So let's do a little bit of a rate forecast. Let's talk about, of course, we don't know what is going to happen. There is no crystal ball, but maybe a little closer to the magic 8 ball. Remember, you shake it up and it says ask again. You shake it up and it says prospects are good. We don't know what's going to happen, but based on a couple of different variables, we can make some good guesses. So what do you think, Anthony? What do you think is going to happen to rates over the next week or two, or when is any events that you think is going to change rates? And then I'll give my opinion after that.
Kind of setting me up for failure there. You're asking a layman, and then the professional is going to answer. But typically we're flat this week. A little bit flat going into, December 1st. And I just keep looking back to the first loan I ever closed was 13.49, and they were ecstatic. And those people, were still able to get into a house, still able to build equity and reach financial freedom, even though it was 13.4. So even at 6 or 7, it's still much better than paying rent, in my opinion.
It is.
I assume it's going to be flat throughout the rest of the year. And then as things spin around in January and February, I don't know. I think it's probably going to go back up a little, but we'll see.
All right. Well, like you said, I certainly didn't want to set you up for failure. I'll give my opinion. We'll keep talking on it. So what I want to do, first of all, I'm going to show you guys, talk about what's moving mortgage rates, what we want to keep an eye on. So when we talk about mortgage rates moving, we're dealing with inflation, one of the things that's of the biggest variable. And then the second piece is the Fed. And basically, those two things are actually working together. As inflation is a bigger problem, the Fed is raising their policy rates. It's a rate called the Fed funds rate, which trickles through the entire economy. The Fed is not directly responsible for adjusting mortgage rates. We've talked about that many times. However, mortgage rates are going to react to what actions the Fed does take in raising rates. So right now, as Anthony said, it's very likely to be quiet for this week as we go into the holiday, and even next week. When we're going to start to see things get a little bit crazier is December 13th and 14th. And those are the dates that you want to mark on your calendar. And I'll throw them up on a little banner here. And these are the dates that December 13, 14, these are the dates that you absolutely want to be kind of keeping an eye on right now. And on December 13th, we're going to get the next report about inflation, the next consumer, the CPI inflation data, which is the consumer price index. Okay. So that report that came out just this month is why we saw rates drop back with this really big green candlestick on our fancy chart here. And that was on November 10th. And when we got basically the CPI inflation report showed that consumer inflation was improving more than expected. And that all of these Fed rate hikes that we've seen since March are starting to have an effect on the economy. They're slowing things down, and inflation is supposed to be getting in check. Now, when we saw that happen, that is directly what led to seeing mortgage rates drop by about 0.5 point across the board. And it was a very, very big move and a very exciting move, because if we had gotten an inflation report that came in stronger, it could have gone the other way. We could have seen rates continue to go higher. We're going to see the next report like that. That's going to happen on December 13th. And right after that, on the 14th, the Fed is going to come out and they're going to make their policy statement. They're going to talk about if they're going to raise rates on that day. It'll happen on the 14th. And then they're going to give us a fresh forecast of all the different Fed members anonymously in what's called a dot plot, where they tell us where do they think rates are going to go to. Now, right now, when we look at probabilities, we're expecting that the Fed is going to raise rates by 0.5% in December. And when that happens, we're not going to see mortgage rates go up at that point, because markets have already priced that in. It's already been factored into mortgage rates. So if the Fed does raise rates by 0.5%, That's expected. So we're not going to see anything negative from there. There's about a 0.25% belief out there that we could see the Fed raise rates another 0.75 point rate hike by 0.75%. It's less likely, but it could happen if they want to be more aggressive in trying to, curb inflation. But right now, a lot of the Fed members, it looks like they're looking at that 0.5% rate hike. They're going to slow things down a little bit. But what they have said is that they're going to continue to raise rates. We'll see it at the February meeting. We're probably likely to see another 0.25%. So we're starting to see it go down. We've had 4 increases in a row at 0.75 at 0.75 at 0.75 of a point. Then we're going to see the next one, hopefully at about 0.5 point. Then it'll go to a 0.25 point in February, another expected 0.25 point in March. And that's going to bring the Fed funds rate to about 5%. And that's where we're hoping to see it peak. Now, if we see an expectation out in the markets that the Fed funds rate is going to go higher than 5%, we're going to see mortgage rates react to that now, and they're going to go up a little bit. They probably won't go up a lot, but we could see, let's say maybe a 0.25%. All right, that you're going to see mortgage rates react to the idea that the Fed is going to raise rates higher in 2023. However, if we see things kind of stay the way they are, or even possibly improve, if we see inflation data come in December that's a little bit better, that could make everybody say, hey, maybe the Fed doesn't need to raise rates to 5%. Maybe they only need to go to 4.75, or maybe they can, lower the amount of time that they stay there in order to curb inflation. So if we get another positive inflation report, it could really help rates improve a little bit further. The fives, maybe. I wouldn't put myself out there, but it's possible, but more likely in the low 6s. For VA loans, though, you may be able to touch the 5. So if you're buying a home sometime over the next 60 days, that's really kind of what you want to be aware of is December 13th and 14th. Those dates, no matter what happens, are either going to be very good for mortgage rates, or they could be pretty tough on mortgage rates and drive them up a little bit. But between now and then, I agree with you, Anthony. I don't think we're going to see much movement at all, and things are kind of quiet. So, well, I've done a lot of speaking on that part. Let me ask you a question. Is in your market in Texas, do you think that now is still a good time to buy a house, and why?
I think every day is a great time to buy a house, regardless of what the rates are. I think that buying a house, if you're financially stable, is the best way to reach financial freedom, because buying a house builds in equity. It provides you a safe foundation. And if the rate is 5% or 7 or 10, buying that house helps you to not flush your money in rent. Now, if you're not financially stable, or you're moving in the next, 6 months or maybe even a year, I don't know that I would be buying a house, because I think prices on houses are going to be coming down just a hair, but we're not going to see a big move so that you're going to be upside down over the next 5 to 10 years. And so my own daughter is looking at that, and we're talking about it. And we decided, hey, based on where the market's at, let's rent for a year. And then over the next, 6 or 8 months, let's really look at what prices and houses are doing. And let's start narrowing down where we want to live, so that in 8 to 12 months, we know that we're going to be here. We're going to buy that house then, as opposed to if I'm leaving in 6 months or I'm moving to a different city. It's not like it was 3 years ago where you could buy a house for 300 and then in 6 months sell it for 350. We're not in that market anymore. But over 5 years, that's certainly going to be the case.
Yeah. Yep, I agree. I think it's a great time. And even like you said, even if we do see a little bit of retracement, so far we've seen more deceleration than we have depreciation. And we've talked about this on some other calls. For those that, want to differentiate, deceleration meaning homes aren't appreciating. They're not going up in value as fast as they were, which was huge. We were seeing 20% year over year increases Yeah, that's a very, very big number. So now we're seeing a more natural 2, 3%, 4%. And in some markets, you may see the values going down a little bit and declining slightly, but we're really, certain price points, especially, but first time buyer homes, there's a lot of first time buyers out there. And even with rates being higher, they want to buy a home. And with limited supply, that keeps the prices up. And, supply is artificially limited right now for a multitude of reasons. One big one being a lot of people have mortgage rates that are in the twos and the threes. In fact, I give lock advice to mortgage originators across the country every day. And today I wrote my email that I send out, and I actually looked back 2 years ago at not the beginning of COVID, but right kind of in that main part after the lockdown when things really had gotten to their lowest for rates. And we were looking at situations, the 10-year treasury was at 0.86%. And today it's at 3.74. So let's see, 3.74. Yeah. So, I mean, that is a huge difference in these last 2 years that we've seen. And it was kind of very crazy, those artificial things, but a lot of people bought homes or refinanced and got rates in the twos and the threes during that time. And now they don't move. They don't want to move. Either they can't move or they just don't want to because it doesn't make sense. So normally people would have babies, or they want to get a bigger house, or they want to change neighborhoods. Maybe they're doing well in their job and they say, you know what, honey, this was our starter home. Let's move up to the next home. And that's not happening as much more now, right? Anthony, are you seeing that in your market too, where people are kind of hunkered down and they said, we're just going to keep it here for now because we don't want to move and have to take these rates at 6 or 7%.
Yeah, and we're seeing that not only in first-time home buyers going to second homes, but also in people that have their primary residence and they're looking at buying second homes or vacation homes. Yeah. That same thought process is going on. But to your point on deceleration, I think what we're seeing now is not that home values are coming down, but sellers are coming to the realization that I can't price my home 10 to 15% over market. And right. So, a year ago or 2 years ago, if market value was 300, they would price it at 320 or 350, hoping to get that higher deal. And we're just seeing that reality is coming back into the market, that if you're pricing your house 10 or 15% over market value, you're not going to get it from a seller's perspective. And so buyers are also winning in that strategy because now all of a sudden I don't have to pay over market to get a house. And so that makes buying that house now even better. We're in a better environment from a buyer's standpoint.
Absolutely. So I fully agree. Just to kind of reiterate what Anthony said, if you're buying a home, you don't have to get involved in the bidding wars that we were just a little while ago, and where it was driving these prices up. And in fact, one of the things that you're not competing against, this was an interesting article in the Wall Street Journal yesterday, is that when they say investor, they don't mean guys like Anthony or I buying a home. They're talking about company investors, corporate investors. And they're saying investor home purchases dropped 30% as rising rates, high prices cool down the housing market. So what this means is that there's less competition, right, not only from normal demand and buyers, but even from these corporate buyers that were, running in and scooping up homes. So this is a great time to get out there, and there's a little more inventory to work with. You're not going to get pushed out or priced out of the market like you were before. And then our expectation is we do expect to see rates fall. I don't think we're going to see the twos and the threes again, folks. I think those days are gone unless something catastrophic happens, which quite frankly, I hope doesn't, because for rates to get back down there, that means there's a lot of other things going wrong. But even in 2023, we do expect that rates could fall into the 5s, maybe even the 4s, in the later end of 2023, middle or later of 2023. So it's a great time to get into a home now. And as long as you can afford it, of course, you should be able to afford it at today's rates, but it's a bonus that maybe a year from now, you'll be able to go ahead and refinance to a lower rate. And that is possible, especially with the VA loan. Anthony, let's just tell everybody 1 minute, just give a highlight on the Earl, and then we'll go ahead and wrap it up for today. So why is the VA loan such a great loan if rates do go down in a year?
Yeah, so if we're looking at 6.5 now on a VA loan, and then the market gives you the opportunity to access 5%, a VA loan will allow you to get that interest rate reduction, and it is a easy process, and so that you can capture that lower rate in your mortgage without having to go through a lot of hassle and a lot of hoops. You don't have to jump through all that with a VA loan.
Yeah. So that's something to keep in mind for all of our veteran borrowers out there. It's a huge advantage you have with that VA loan. So awesome. Well, thank you, Anthony. Appreciate you joining me today. Is there anything that you'd like to leave everybody with before we wrap up?
No, I think that pretty much covers it. I don't think that, to your point, I don't think we're going to see those 2% and 3% rates come back for a long time unless something significantly happens. And the reality is, lenders and companies that service mortgages, they're not in the business to do that for the buyer's benefit. They're in it to make money. And at 2% and 2.25% and 3%, they weren't making any money. And so I don't think we're going to see back down there. We may see in the 5s, but they need to make some money over time to recover from COVID expenses, just like everybody else. So hopefully people will still be interested in buying. Now's a great time. Certainly in January and February, it'll be a great time to get that move made at the beginning of the year.
Absolutely. So, well, thank you, everybody. And hopefully you all have a wonderful Thanksgiving. We are grateful to have you and look forward to seeing you next week. Thanks again, Anthony, for joining me. Have a fantastic Thanksgiving yourself, my friend.
Okay. Appreciate it. See you.